Why I don't use a stop loss. My personal trading experience. Have you ever taken a trade? Your analysis was right. Your direction was also right. But still, your stop loss got hit. And the most frustrating part, just a few moments later, the market reversed and moved in the exactly the direction you originally expected. This has happened to me several times, and that's one of the reasons I personally don't prefer using a stop loss in my trading approach. But let me make one thing very clear. I'm not saying every trader should stop using a stop loss. No, this video is simply about my personal trading experience and why I personally prefer a different approach to managing the risk. Hello everyone, welcome to No Chart Finance English again. And today's video is a little different. I'm going to talk about something based on my personal trading experience. Why don't I use a stop loss and what problem have I personally experienced, especially when the market becomes highly volatile? Because for me, the biggest issue is not the concept of a stop loss. The issue is how the market behaves around the stop loss level. Where did I find the problem? Let's understand this very simply. When you take a trade, you have an analysis. You believe the market may move in a particular direction. Then you place a stop loss and basically say, if the market reaches this level, I will exit the trade. Conceptually, that makes perfect sense, but the market does not always moves in a straight line, especially when volatility is high. The price can move sharply up, then down, then back up again. And during such conditions, if your stop loss is relatively close, even a temporary move against your position can trigger your stop loss. In my experience, there have been several situations where I took a trade based on my analysis. I expected the market to move in a particular direction, but suddenly volatility increased, the price moved against me, and my stop loss was hit. I was out of the trade, but the story did not end there. A little later, the market reversed and moved in exactly the direction of my original analysis. Now, was my entire analysis wrong? Not necessarily. Sometimes the temporary volatility itself triggered my stop loss, and then the market made the move I was originally expecting. That experience became a very important learning point for me. What happens during high volatility? When volatility is high, the market can make very fast movement. This can happen because of news, global market movements, economic events, or unexpected developments. The price may temporarily move above or below a level and then quickly return. If your stop loss is placed within such a temporary move, it can get triggered. And after that, the market can reverse. So sometimes the loss may not simply be because your entire market analysis was wrong. It can also be the combination of market volatility plus a stop loss placement. Does that mean a stop loss is wrong? No. This is very important. A stop loss can be a useful risk management tool. For many traders, it can work perfectly well. If your strategy is based on a specific stop loss levels or you want to define a maximum planned loss, then a stop loss can be useful. My point is simply this: based on my personal trading experience, I don't prefer to rely on a stop loss as my primary risk management approach. The biggest limitation I see, for me, one of the biggest limitation is that a stop loss makes a decision based on a specific price level. It does not know why the price reached that level. Was it just temporary volatility? Was it a quick spike? Was there a rejection? Did the market actually change direction? The stop loss does not analyze that. If the price reaches the level, the positions exits. That's what made me uncomfortable with relying on it. Because I don't only want to know did price reach this level, I also want to know what is price doing around this level. Is it just temporary volatility? Is there rejection? Is price returning back into the range? Or has the market actually changed its structure? For me, that distinction is important. Level versus price behavior. This is why I don't like making decisions based only on a single level. Let's say the price moves below a support level. If you are using fixed stop loss, your position may be exited immediately. But what if the price comes back above that support shortly afterward? The situation may be completely different. That's why, for me, price behavior is more important than simply looking at a level. So, how do I manage risk? Now, you may ask, if I don't rely on a stop loss, then how do I manage risk? For me, risk management starts before taking the trade. I think about what happens if the market moves against me. What should my position size be? How much risk am I actually willing to take? And how will I manage that risk according to my strategy? I also use hedging as part of my risk management approach. But I'm not going to explain hedging in this video because I have already made a separate detailed video about it. If you want to understand what hedging is, how it works, and how it can be used, you can watch that video as well. One very important point. Don't think if I don't use a stop loss, I can't lose money. That's completely wrong. Loss is a part of trading. Whether you use a stop loss or another risk management approach, risk will always exist. And if someone simply removes their stop loss after watching this video without having a proper risk management plan, that would be a mistake. You need to understand your strategy, your capital, your risk tolerance, and your position sizing. My biggest learning has been we can't control the market, but we can plan our trade. From my experience, during periods of high volatility, there have been times when my stop loss was triggered and the market later moved in my original direction. That's why I personally don't use a stop loss as my primary risk management approach. Instead, I focus more on price behavior, position sizing, risk planning, and hedging. So, why don't I use a stop loss? Because in my personal trading experience, during high volatility situations, a stop loss has sometimes taken me out of a trade because of a temporary market move. And shortly afterward, the market reversed and moved in the direction I originally expected. But again, this does not mean that a stop loss is wrong, and it does not mean every trader should stop using it. This is simply my personal trading approach and experience. The right risk management method for you depends on your strategy, your capital, and your risk tolerance. If you found my experience useful, please like this video, and if you want me to make the next video about a stop loss mistakes traders commonly makes during high volatility with practical examples, comment below a stop loss. And if you want to learn more about trading psychology, risk management, financial market education, and back tested strategy, don't forget to subscribe, follow to No Chart Finance English now. I'll see you in the next video. Until then, trade with a plan, not with emotion.